I've been hearing people comment that, Adam, the stock market can't go up without QE, without quantitative easing. So they believe that the only reason the stock market has gone up over the last 10, 20 years is because of quantitative easing. So now that the Fed has stopped QE as of March of this year and now has embarked onto quantitative tightening or QT, stock prices can only go down. So is it true that stock prices can only rise if the Fed starts QE again? Let's find out in this video. So first, let me explain what quantitative easing means, or QE. So whenever the economy is in trouble, and this began in the great financial crisis of 2008, when we were going through like a potential depression. So the Fed, to save the economy, it can do two things. Number one, it can lower interest rates, the Fed funds rates, and it cut interest rates all the way to zero. So by doing that, it lowers the short-term interest rate. The second thing the Fed can do to save the economy, in addition to lowering interest rates, is quantitative easing, or QE. So what does it mean? QE is a process where the Fed, they embark on buying treasury bonds and mortgage-backed securities from banks. So what happens is when the Fed buys all these bonds from the banks, and by the way, these are long-term mortgage bonds and government bonds. By buying these bonds, what happens? The bond prices will go up and the interest rate on the bonds, known as the long-term yields, will go down. At the same time, when the Fed buys these bonds from the banks, they'll credit money into the banking system. So it does two things. Number one, it increases the money supply. Now, when people think of QE, they think that the Fed is literally printing money and creating more money into the economy. That is a misconception. In reality, the Fed does not actually print money. All it does is it creates a credit and liquidity into the banking system. Now, people think that in theory, if the banks have more liquidity, they will lend more money and they will increase consumer demand and corporate investments. Now, that's in theory. But in reality, if you actually speak to many bankers, they'll tell you that loan growth is not based on bank liquidity, because most of the time, the banks do not have a liquidity issue. Loan growth is based on loan demand, which is more affected by interest rates and not really money supply. So don't think that when there's QE, there's money supply increasing, you and I have more money to spend. That is absolutely false. That is a misconception. Now, what really happens in QE is that all this serves to reduce the long-term interest rates, or the 10, 20-year, 30-year treasury yields go down. Now, that is what really impacts the market. So how does it impact the market? In two main ways. Number one, when long-term interest rates go down, it decreases the discount rate that analysts use to value assets like stocks. Now remember that the value of a stock is based on the present value of all its future cash flow, which is calculated based on the discount rate. So when discount rates go down, it increases the present value of the future cash of the asset. Now, this affects especially stocks that are not making money now, that they are expected to make money in the future in 5 to 10 years, like for example, Roku or Teladoc, or many of the stocks held by ARK ETF. These are called long duration assets. So because these companies don't make money now, they make money only in the future, when you discount them to the present value using a lower discount rate, it increases their value. So in other words, by reducing the discount rate, it makes stocks overvalued, especially stocks that are not making money now. Stocks that are making money now, not that affected, but stocks that are not making money get overpriced. That's why ARK ETF, during the QE session, they went up dramatically. Even though the companies were not making money, they were pumped up because of the lower discount rate. The second thing that this does is that it increases the demand for riskier assets. especially again, assets that are non-productive. So remember, when long-term interest rates go down, people think, hey, if I put my money into long-term bonds, I only get 0.5% or less than 1%, I'm wasting my time. So they rather put their money into things that will give them more return. So they go into cryptocurrencies, they go into speculative stocks. So all this does is it creates a bubble into non-productive assets like cryptocurrencies, and it creates a bubble into companies that are not making money. So to summarize, QE reduces long-term interest rates like the 10-year Treasury yield. And what that does is that it increases what people are willing to pay for riskier assets and what people are willing to pay for stocks, especially stocks that are not making money. So this actually increases the price multiple on stocks, either through the PE ratio or the price to sales ratio. So this increases the PE ratio or the price to sales ratio of stocks. Again, especially those of them which are not making money. So ever since the financial crisis of 2008, the Fed has gone through 4 rounds of QE to pump up the economy. We had QE1, QE2, QE3, and recently in 2020, the biggest QE of them all, the mother of all QEs, we had QE4. And this has ballooned the Fed's balance sheet to $9 trillion. So what has all this done? This has increased all stock prices and increased the prices of all kinds of risk assets. So again, good companies, bad companies, profitable companies, unprofitable companies, stupid companies, they've all gone up. So it has made a lot of people think that they are geniuses. It has made idiots think that they are geniuses because everything they bought went up. But now that there's inflation, the Fed has to stop QE and go into QT, which is quantitative tightening. So to bring inflation down, besides increasing interest rates, which the Fed is doing, they are now doing quantitative tightening. So again, what is QT? Is the opposite of QE. So instead of buying bonds, now the Fed is letting the bonds mature and not renewing the bonds. And at the same time, they're also selling treasury bonds and mortgage-backed securities. So what happens when the Fed is selling all these government and mortgage bonds? By selling these bonds, it causes the bond prices to go down and the interest rates on the bonds to go up, or we call that the long-term yield. So the 10-year, 20-year, 30-year yield goes up. And subsequently, it decreases the money supply, which are the credit or the reserve held in banks. So how does this affect you and me? Again, now that long-term interest rates have gone up, people rather put their money into long-term bonds and get a better yield, so it reduces the demand for risk assets. It increases the discount rate and reduces the intrinsic value of companies that are unprofitable right now. So, or in summary, QT, what it does is it increases long-term interest rates like the 10-year Treasury yield, and hence it reduces the multiples people are willing to pay on stocks. So it reduces the PE ratio on stocks and the price to sales ratios on stocks. Now again, does this affect all stocks? No. It only affects stocks that are not very profitable. But for stocks that are very profitable and are able to grow their earnings, their PE ratios will be able to sustain. But those that are not profitable, the PE ratios or price to sales ratios will crash because there's no more easy money propping up these stock prices. So let's come to the million-dollar question. Can share prices go up without QE? And can share prices go up if there's quantitative tightening? The answer is yes, for certain stocks, but no for other stocks. So to understand this concept, take a look at this formula. What determines share price? Share price is determined by the PE ratio or price multiple multiplied by the earnings per share. This makes sense because if you take this divide by this, it cancels out and that gives you the share price, correct? Now, earnings per share is made up of two things. Earnings per share is made up of the earnings of the company or net income divided by the shares outstanding. So in other words, for share price to go up, three things have to happen. Either PE goes up, or earnings go up, or shares outstanding goes down. Does this make sense? So these are the three things that increases the price of a stock. Now, what happens during QE? Remember that in QE, PE ratio goes up on all stocks. So because of that, even stocks that are not making money, even stocks that are issuing new shares, their share price will go up because PE goes up. Very simple, all right? But now that there's no more QE or there's quantitative tightening, PE ratio is not going up anymore. In fact, PE could even be going down for certain stocks. So if PE is going down, can share price go up? Yes, if the company's earnings are going up. So in this environment, only companies that have earnings growth, that have strong earnings growth, will see their share price go up even if the price multiple goes down or doesn't go up anymore. Okay? So either earnings growth or growth in free cash flow. So what causes a company's earnings to grow? Two things. Either revenue is growing at a very fast rate. For example, Nvidia is growing revenue at, long-term 20-30% revenue growth, or revenue may grow slower at 5 or 6%, but earnings could still grow double digits as long as there's profit margin expansion, which means the company is achieving economies of scale, so their cost of business goes down, or they've got pricing power and they raise prices. This increases their margins. So for a stock's share price to go up, its earnings must grow enough to offset the potential fall in the price multiple as a result of QT. Now, at the same time, a company's share price can also go up if the number of shares outstanding goes down. So how does a company reduce the shares outstanding? Through share buybacks. So companies that are buying back shares, companies that are growing their earnings, will still see their share price go up even without QE, even with quantitative tightening. So, in summary, what causes share price appreciation? Share price appreciation comes from, number one, earnings growth or free cash flow growth. Number two, it comes from share buybacks. Number three, it comes from dividends. And finally, it comes from multiple expansion, which is either the PE expanding or the price to sale expanding. So either one of these four things causes share prices to go up. Again, with no more QE, if there's no more QE and with QT, you no longer have the last factor, right? So if you don't have this, doesn't matter, share price will still go up as long as you have got this, this, or this, the first three factors. But for companies that do not have earnings growth, in fact, they are still losing money. For companies that are not buying back shares, they keep issuing new shares, or companies that don't pay dividends, then I'm sorry, their share price will never go up anymore until the Fed does QE again to raise price multiples. So let me give you a few examples. So let's take a look at the first example, which is MasterCard, one of the core holdings in my portfolio. Now, let's take a look at the last 5 years. And you can see that over the last 5 years, MasterCard has increased in price by 115% in total, all right? So if you analyze it, that is roughly about 18% increase in the share price a year over the last 5 years. Now, again, where did the share price increase come from? Did it come from increase in price multiple? Did it come from increase in earnings growth or share buybacks? Well, let's take a closer look. So you can see that in the last 5 years, MasterCard's revenue increased 13% a year, which is not that high, but it's okay, right? But notice something, although their revenue went up by 13% a year only, but their actual earnings per share without non-recurring items, we strip out the exceptional items, their earnings per share grew at 19%. So how can it be that their revenue only grows at 13%, but their earnings per share grew at 19%? Well, there are two reasons why. Number one is because they have been improving their profit margins. So with lower revenue growth, but profits go up because of higher profit margins. Number two, because of share buybacks. They've been buying back shares. You can see the shares outstanding reducing over time by about 1.9%. So with less shares, with higher margins, it causes their earnings per share to grow at 19%. All right, and that is how you get the price appreciation of 18.4%. Now, what's interesting is that if you look at the last 5 years, has their PE, has the multiple expanded? Not really, right? So you can see that, yeah, PE expanded here, it expanded here, but overall, you can see the PE ratio today is lower than where it was 5 years ago, or in fact, a couple of years ago, because of QE winding down and now quantitative tightening, right? So again, MasterCard is a good example that even without QE, even without the PE expanding, share price will still go up because revenue is growing, shares are being bought back, earnings per share are growing. Another one of the stocks that I own, which I know will keep going up even without QE, even with QT, is Lowe's. Lowe's is the second largest home retailer or home improvement retailer in the US. And you can see that in the last 5 years, Lowe's grew by 153% share price appreciation. Again, where did the share price appreciation come from? Did it come from the increase in price multiples? Let's take a closer look. So you can see in the last 5 years, revenue of Lowe's increased 13% a year. Not that exciting, only 13%, but earnings per share went up 28%. So once again, how is it possible that revenue grew at 13%, but earnings per share doubled? Or rather, the growth is double that of revenue? Because, again, margin expansion, they are improving their margins, as well as share buybacks. You can see the number of shares outstanding going down over time. They reduce the shares outstanding by about 4%. That increases the earnings per share. And if you look at the PE multiple over the last 5 years, did it go up? No, in fact, it has been going down. You can see that in 2019, the PE multiple was as high as 40 times earnings. And since then, the PE has come down from 40 times earnings to currently about 20 times earnings. So even though the PE multiple went down from 2019 to today, the share price still went up, even with PE coming down. So, like I said, even if PE goes down because of quantitative tightening, it doesn't matter as long as it's offset by a rise in revenue growth, earnings per share growth. Now, for companies that are not making money, they'll be the ones that will have a problem going up in price without the quantitative easing. So an example would be, again, a stock like Roku. So if you take a look at Roku, you can see that over the last 5 years, it lost 24% over 5 years. And if you take a look at the financials, you can see that it's not making money, right? So, yep, revenue has been growing at 21% a year for the last 5 years, but earnings are negative, right? It's negative free cash flow, negative earnings, and in fact, they are issuing more and more shares. Shares are going up. So if you go back to that formula, what happens? If earnings are not growing, if earnings are negative, if shares outstanding are increasing, share price can't go up unless the price multiple goes up. In this case, we're looking at price to sales ratio, okay? So you can see that when the price to sales ratio goes up, share price goes up, but then it's not sustainable. The moment there's no more QE and the price to sales ratio from 30 times price to sales and it drops to now 1.8 times price to sales, the share price goes down. And the share price can't go up anymore unless the company starts making money. And that is something that will take some time. Now, some of you may ask, Adam, how about companies like Meta or Amazon? Their earnings have dropped tremendously recently. Are you worried about those? Now, those are the ones that I'm not worried about because their profits drop recently, not because revenue dropped. In fact, revenue has been increasing very well, okay? The only reason their profits dropped temporarily because these companies spend a lot on R&D, on research and development. So this is not something that is long-term. It is short-term increase in R&D, so short-term increase in expenses, leading in a short-term fall in earnings per share. But once they stop or reduce their R&D expenses, earnings will resume again and the share price will go up again, even without QE. So let's take a look at Amazon, for example. If you look at Amazon, over 5 years, it's gone up tremendously, but again, big crash this year because of the fall in earnings, because again, in high R&D costs, right? So as a result, it only grew 45% over 5 years, which for Amazon is really, really very low. But it's temporary, okay? So if you take a look at Amazon, the last 5 years, revenue grew at 26% a year. So revenue is still growing. Earnings per share over the last 5 years grew at 71%, which is amazing, okay? But it's the last 1 year that it had a big fall in earnings. Not because revenue fell, but because of the increase in R&D expenses, and also because they overhired people, right? Which now they are letting go of the people, so that should reduce the OPEX, reduce the R&D over time, then earnings will grow back again to 60-70%. And of course, Amazon is not buying back shares, they are still issuing shares, but they started to buy back recently. But in the last 5 years, you can see shares outstanding has not been going down yet. So even though revenue has been growing at 26%, earnings grow at 71%, their share price has only grown at 7.8% a year for the last 5 years. So it is now very, very undervalued because of this recent fall in earnings. So once earnings start to rebound, then the share price would easily double from current levels. So same thing goes with Meta, same thing goes with, for example, Salesforce, that are spending a lot on R&D or acquisitions recently. Okay, so to summarize this lesson, what do we want to do? Now, we don't know how long they are going to continue quantitative tightening, right? In fact, my belief is that they're not going to continue for that long. It's going to stop once inflation comes down, or if the economy goes into recession, they may be forced to go back to QE again, or they are forced to start to reduce interest rates. Now, we don't know that. We can't predict that. But the point is this: even if they continue with QT, companies will still increase in price as long as we invest in stocks that have got earnings growth and free cash flow growth. That either comes from revenue growth or profit margin expansion, or invest in stocks with share buybacks or stocks that pay good dividends. Now again, does it mean that stocks must have all three for the share price to go up? No, it doesn't need all three. So for example, if you look at Nvidia does not do share buybacks yet. Nvidia does not pay dividends because its earnings are growing at over 25%. So that by itself is enough to increase Nvidia's share price over time, even without share buybacks, even without dividends. Okay, but if you look at United Health, which I also own, by the way, I own all these stocks, Nvidia, United Health, and Lowe's. For United Health, they have earnings growth, they have got share buybacks, and they've got dividends. They've got all three. And that's why if you look at United Health, the share price has been going up. In fact, the PE ratio of UNH has been going up as well, even without QE. Because when a company has got strong earnings growth, its price multiple can expand even without QE. Finally, same thing with Lowe's. Lowe's has earnings growth, share buybacks, and dividends as well. Finally, what can we expect from QT moving forward? And do I foresee that price multiples will fall a lot more? No, I don't. And let me just explain why. So during the whole QE process, as the Fed has been buying bonds from the market, their balance sheet has ballooned all the way up to 8.9 trillion. That's almost $9 trillion US at the beginning of this year. So since then, the Fed has been selling bonds to reduce its balance sheet. Now, ever since September of this year, they have been reducing their balance sheet by about $95 billion a month, reducing their bond holdings. Now, is that a lot? That seems like a lot, $95 billion a month, but it's actually very small in the context of the bonds that they actually hold. So their plan is to reduce by $95 billion a month. Now, think about that. It will take them 2 years to reduce their portfolio by 2.2 trillion, which is their plan. Now, even if they do that, that means from 8.9 trillion, they're going to reduce their balance sheet to $6.7 trillion. That's still a lot, okay? And that's at 6.7 trillion, it will still be at where it was after the 2020 QE session. In other words, there's still going to be a lot of liquidity in the banking system. Now, if you take a look at the start of 2020, which is somewhere over here, the PE ratio of the market was at 27 times earnings, which is a lot higher than where it is today, all right? Currently, the PE ratio of the market is about 20 times earnings, which is below the 10-year average, and we are actually near the lows of it. So I suspect they won't be able to continue QT for the next 24 months, because once inflation starts to come down dramatically, we may even have deflation or even a recession next year. I think they'll be forced to pause QT and even start QE again, possibly, or they may start to have to hold interest rates. So in that case, I foresee, in fact, price multiples may expand again next year. That would offset a contraction of corporate earnings in the event of a recession. So let's see what happens. Hope you enjoyed this video, and I'll see you guys next year. In the meantime, may the markets be with you, and have a Merry Christmas, what's left of it, and a Happy New Year. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.